Let me show you a company with a 5.7% yield, a payout ratio of 77%. It's been growing its dividend for 8.6% a year for the past 5 years, and it's been growing that dividend for 21 years. If you would have put $1,000 into this company 10 years ago, today you would have $1,085 with an average annual return of 0.82%. So that doesn't actually sound good at all. This stock is IBM. Now, IBM is a good example of how your income or your dividends can kind of skew the way that you account for your returns. Some people will buy things just for the yield, for the dividend growth or something like that. But with IBM, on paper, the dividend looks really good, but after 10 years, you would have made no money. That 0.8% a year is with dividends reinvested and that growing dividend. And AG&C is another example of something like that, where it has a high yield, sounds really nice, but the annual performance is always lower than the yield. So I love, investing for income. I love dividends. I love selling option premium. I love getting that income from my investments. But if I only account for like the dividends, I only buy a company for the dividends, am I really being honest with myself on my returns? Like, yeah, I get this nice yield and raising dividends over years, but how does the share price affect that? Am I really winning out if I got a good steady dividend that maybe even increases for a long time if the share price isn't keeping up and it's eating away at all those? And this applies to the wheel strategy and selling puts and selling covered calls. And that's what I want to talk about in this video, is how to honestly account for how much you're making on these strategies, because there's a lot of belief that the wheel strategy is risk-free and you can't lose and all this. First though, if you're new to the channel, I'm Justin. I like to talk about dividend investing, income from options, financial independence, and document my own journey towards financial independence. So if you get anything out of this video, I'd really appreciate it. Thumbs up, and if you subscribe to the channel if you haven't, because I'm putting out videos every Monday, Wednesday, and Friday. So my big criticism is that there's a belief that the wheel strategy is win-win, you can't lose, it's risk-free, but you can lose money on the wheel strategy. And another thing is that they say that you get to keep the money. You get to keep the money, your option premium, and that's yours. But yes, it is your money once you get paid those premiums, but if you're selling covered calls on a stock that's going down, you might have a little bit of money here, but you might have a big chunk of shares over here, 100 shares of the stock that's going down in value, and you might be getting a little bit of premium for that. But still, is this money that you can take out, go out to the bar with when you have all this money going down? Now, the way I account for my premium is I don't really count it until the contract is closed out or the cycle is finished. So you start with selling a put and you get that premium, and I don't count that premium until that contract is expired. And if I get assigned the shares, I don't count that until those shares get called away. And then I can add it all up and see what my final profit and loss is. So we'll start with selling a put. We sell a $50 strike price and say we get $1 in premium for that. So that means our break even is $49. Strike price subtract our premium is our break even, $49. Three things can happen. Those hopefully will expire worthless, and I get to keep that full $100 in premium, $1 per share, hopefully I get to keep that because it expires worthless. Second option is that we might want to roll or buy to close that early. Now, if we buy to close that early, I have to, say we buy to close for 10 cents. Then I have to subtract that 10 cents from our original premium of $1. So buy to close for 10 cents, that means my walk away money is 90 cents on that original put contract. And then if I'm rolling, then my new premium starts a new contract and a new cycle. Third thing that can happen is I could get assigned, and then I get the shares, and that's where I kind of have to drag this into more cost basis reduction. Now I have 100 shares with a cost basis of $49 a share, $4,900 worth of shares. And hopefully I can sell covered calls against that for a strike price of $49 or higher, so I don't lose money if these get called away right away. So I sell a covered call, get 75 cents in premium, and we'll say $49 strike price. So now my cost basis is now $48.25. We're reducing my cost basis with this money. This isn't walk away free money for me yet, because I'm using it to reduce my cost basis on those shares. Now, if these get called away at $49, that means my profit is $75 and not $175 because I had to take possession of those shares. And if they don't get called away, then I sell another covered call on it for, another 75 cents, and I keep repeating this process and lowering my cost basis until these shares get called away. Shares get called away, I add up all my premium, I have my cost basis from when the shares were assigned, and I got all the premium I got from my covered calls. I add all that up and subtract that from my strike price, and that is, how much I get, whether it's a profit or loss. Like, I can't see spending your $75. That's not really profit. That's really not, I can't go to the bar with that money when I got $4,900 that I'm worried about, and it could lose value when I'm I've been assigned, and these shares could be going down, and they'll go down much faster than the $75. Now let me take you into my spreadsheet and kind of see how I do it on my spreadsheet, and I calculate it and everything like that, all right? So here's my spreadsheet. I got a column for the date, the stock, the price that the stock is trading at when I sell my put, my strike price, my cushion, this is how much the shares have to fall before I'm assigned, my expiration date, number of contracts, how much money's tied up, right? So if I got a $34 strike price, I need $3,400 tied up to sell this put. Then my premium, fees, and then how much money I receive after fees, days in the trade. What we got? Return on the trade on an annualized basis here, and then my notes. And then another column for if I buy to close. This is the price I buy to close at. Let's go ahead and look at this Pfizer. So, right, it was $37.80. I sold the put and got $154, so $152.96 after fees. And if I was to close this out, I would, buy to close, and then I would, say I buy to close for $10, right? $10, and then I'd go in here, subtract this column, and then this is my walk away. This all calculates automatically. So my trade would be 2% or 23% annualized. All right. That's how it is now. Now, if I get assigned, like my CVS, I got assigned, right? I got assigned, and then I don't have this worked out completely on how I want it formatted, but this is me selling covered calls. I sold a $60 strike price for this expiration date, and I got $44.48. Then they paid me a $50 dividend the other day. And then I sold another $225 covered call, and then another $74.48 covered call on this. And then when this is all finished, I'm gonna add up all the premium I received, subtract that from my strike price to see if it's profitable or not. Now, in my E-Trade account, this has an accurate cost basis, but I haven't sorted out how I want to format this quite yet. So that's how I kind of account for it. I think that's the honest way to, get a real accurate number on how much money I make after selling puts and covered calls. Now, I do have a little tweaking to do in my spreadsheet with the covered calls because I don't know how I really like that and how everything's going to work out. So I do want to play with that a little bit. But I think that's the general approach, is an accurate, honest way to account for the profit and loss of selling the wheel strategy. But I think that's all I got for this video. Hope you get something out of it. Hope you give me a little thumbs up if you did. Go ahead and leave a comment down below and say hi. Subscribe to the channel if you haven't, because I'm putting out videos every Monday, Wednesday, and Friday. And then I want you to go have a good day, all right? Justin out.